So for those of you who have come to our events before, we kind of do these key messages and kind of build our presentations around it. You'll see this format here a lot today. But six key messages around the outlook here. I think the industry has had a few good years, but things are going to be pretty challenging, at least this year, potentially next year. Lots of issues that are essentially pretty strong headwinds against the industry. A primary driver for these headwinds centers around energy and feedstock costs. And we've already seen a lot of these challenges in the last few years. But in addition to that, there's a pretty uncertain demand outlook that the industry is trying to address, and that we think is going to have a pretty negative impact on capacity utilization rates across multiple segments within the industry. It's not all bad news though, and the third insight there is that there are interesting megatrends, and a lot of the conversation, for example, with Bob was centered around electric vehicles and what opportunity that creates for chemicals and materials. So there are some interesting megatrends, whether it is energy transition, whether it is the opportunity around hydrogen, electric vehicles, the infrastructure investments. I think all of these will create and expand markets for plastics and polymers. The fourth insight, generally speaking, there's a lot of commoditization that's happening in the industry, but even within fairly commoditized markets, we are seeing a strong push to differentiate your products, to develop those solutions, for example, that Bob was talking about earlier. And I think that is creating some opportunity to kind of get some sort of a premium on some of the pricing for some of these commoditized products. And we'll talk a little bit about that. And then the last two messages are really the challenges associated with sustainability, recycling, and then finally decarbonization. And again, we'll build a little bit on some of the discussion that's already happened here. So let's quickly go through a couple of these things, right? I mean, so as I said, the industry has had a few good years. Generally, the chemical industry has outperformed the broader markets, and particularly so in the last few years or so, when the industry essentially reaped a lot of benefits from consolidation and things like that. But as we look at some of the key factors that will impact the industry going forward, you'll see a lot of yellows there as opposed to greens. I mean, feedstock cost and competitiveness, at least in some parts of the world, like North America in particular, tends to be fairly promising. We are also seeing new markets open up, and that will be supportive of the industry. But if you look at GDP growth outlook, obviously there's the risk of an economic recession or at least some sort of a slowdown. Inflation's been high, interest rates are high, and of course there are broader societal pressures around sustainability, circularity, and decarbonization. All of these essentially pose significant headwinds. I think the consensus out there is mixed in terms of whether we will see an economic recession. When we read reports out there, it seems to suggest that maybe we are heading more towards a slowdown. But if you look at more anecdotal data, right, there's a lot of worrisome trends out there. Automobile sales, for example, in the US saw a 10-year low essentially last year in 2022. Housing starts have slowed down fairly significantly. Some of this could be offset by spending on new infrastructure, but broadly speaking, it's a challenging outlook there in terms of one of the largest markets for the chemical and petrochemical industry. U.S. chemical exports, we haven't gone back to the levels that we saw pre-COVID in 2019, and essentially the trade surplus has declined quite a bit. So all of these are fairly challenging factors. Inflation is obviously hurting chemical companies. A lot of that is because of the conflict in Europe, because of the impact that it had on feedstock prices, and I think some of these challenges will continue. Energy prices have moderated, have come down quite significantly in the last few weeks and maybe a month or so. But broadly speaking, some of the structural challenges around energy supply, especially into Europe, remain, and so we are not very confident that we're going to see big changes to what inflation will look like in the next year or so. Interest rates, obviously high interest rates have a pretty big impact on returns and capital investment decisions. We are seeing that across the value chain. In projects that we have done, for example, a year ago, when we are going and revisiting them because of delays with getting those projects approved and things like that, we are seeing the economics shift quite widely because of the cost of debt. We also think that a lot of decarbonization investments, whether it's, for example, renewable power assets, which have traditionally had lower returns than fossil fuel-based power generation assets, when you factor in the higher cost of debt, they become a lot more uncompetitive when you compare that to, let's say, traditional fossil fuel-based power generation. So these are some fairly significant challenges in terms of capital allocation, in terms of approving capital investment decisions. Now, having said that, I think we shouldn't forget the fact that there are some fairly important structural drivers in the market that will be supportive of the industry. One of them is, for example, investment in housing. The US has gone through a pretty long cycle where it underinvested in housing, and we think that that's now just coming back up in the last couple of years or so. So while there might be some sort of a stagnation here over the next few years, we will need to invest quite a bit in housing. So some of these longer term structural drivers persist, which tell us that it's not all gloom and doom, and that there is probably some room for optimism here within the next couple of years. Let's talk a little bit about feedstock costs. So obviously, natural gas prices have had a pretty interesting time in the last couple of years. Obviously, a lot of the action around natural gas pricing and the volatility that we saw was in Europe, primarily around LNG, and also a lot of that was translating into LNG pricing into Asia as well, and we'll talk about that here in a second. But what was interesting was that a lot of it was felt back here in the US as well. I mean, conceptually, and if you'll come to the ADI forum tomorrow, we'll talk about natural gas pricing and marginal costs of producing natural gas. The US can produce natural gas for the next 25, 30 years at less than $3 a million BTU. The resources there, the ability to exploit that resource is there. What we don't have enough of is pipelines. We'd like to see more pipeline capacity come on stream. And increasingly, we are now getting to the point where natural gas production is now being capped by the availability of infrastructure. And I think some of that was felt here in the US last year. And therefore you saw natural gas prices climb up to fairly high levels. But of course, they have come down, and our general forecast here going forward is that natural gas prices will probably stay less than $4 a million BTU or so. Some of this is driven by the fact that we've had a warm winter. The weather has been not cold enough to drive a lot of demand, and as a result, natural gas storage levels are very high. They're at 5-year highs right now, and the general expectation is that we're going to run out of storage capacity in the next few months here in the US, which means low natural gas prices. So therefore, if you look at price elasticity, right, we haven't seen a big difference. In fact, if you notice the data here on the right side is only through 2021. We updated the chart here for 2022 yesterday, thinking that we're going to see a higher level of a price elasticity impact. But in spite of natural gas prices being almost 50% higher last year in the US, industrial gas demand was higher by another 15-20%. So essentially, the traditional model of price elasticity that we have thought of in natural gas markets is shifting. And a lot of that is because there's little room here in the US to go outside on natural gas, to substitute natural gas with something else. If you look at the top left chart, which is the consumption of natural gas in the petrochemical industry, which is the largest segment of natural gas consumption, if you see the line below, that is the share of that consumption that can be switched and you'll see that it's essentially very close to zero, right? So essentially, the industry doesn't have a lot of options, at least in North America, to move beyond natural gas. And as a result, there's the willingness to consume more of it even when prices are high. This is the same chart, but what we've done here is looking at natural LNG prices in Europe and Asia. Obviously, the scale is very different. The US scale capped out at $9 a million BTU. This is almost 10x higher at $80 a million BTU. So essentially, Europe was paying very high prices for natural gas this past year. Of course, going forward, we think that this is going to come down. There's been significant investment that has been made in adding new regasification capacity in Europe. There's been a pretty big shift towards energy efficiency measures. And the more concerning piece is that there's quite a bit of petrochemical capacity that has been industrial capacity more broadly, petrochemical capacity more for our interest, that has been taken offline, and the prospects of that capacity coming back online are not necessarily uniformly the same. And as a result, we think that going forward, natural gas prices should stabilize more into the $25-30 range, and we expect the markets to invert back where the premium shifts towards Asia going forward. So I'll skip through some of this or go through this very quickly, but obviously a significant amount of petrochemical capacity was impacted, in particular the methyl methacrylate and melamine markets, production capacity, the ammonia production capacity. A lot of this capacity was taken offline. There's a lot of talk and discussion about how some of this capacity is unlikely to return. If you dive deeper into where petrochemical capacity in Europe is centered and how does that relate to, let's say, reliance on imported Russian gas, a lot of that is really capacity in Germany. So this is, for example, a snapshot of how much benzene production in Europe is concentrated in Germany and what share of that depends on Russian gas imports, and it's as high as 50%. So there's a lot of this capacity that has been distressed. We see a similar picture for ethylene production, propylene production as well, fairly high capacity numbers that rely very heavily on imported gas. A significant chunk of ethylene production in Europe is liquids fed, but you know, the gas fed part is not insignificant. It's not trivial, and that's the piece that has been pretty significantly impacted. And as a result, we see ethylene imports into the Europe rising, and because of that, ethylene prices rose in 2022. Here in North America, the cost competitiveness, the advantage that ethane has continues undiminished. In fact, it has only strengthened in the last year or so. We expect that to only continue to stay strong here going forward. But globally, because of multiple factors, and more importantly, the challenges associated with demand, we expect stagnation and some decline potentially in ethylene production capacity here going forward over the next couple of years, which is reflected in that operating line there. And as a result, of course, all of this will start flowing back into margins. We've already seen softening of the margins, which rose very substantially over the last couple of years coming out of the pandemic. And essentially both polypropylene and polyethylene margins fell here quite a bit last year, and we expect further reduction going forward. Taking a slightly longer term view in terms of where these markets are headed, the number of megatrends, and every year we highlight a few. This year I want to talk a little bit about what we are seeing in and around energy transition. So that's batteries, for example, solar, hydrogen infrastructure, and then of course 5G investments. Each of these markets has different impacts on the chemical industry. I think Bob earlier was talking about how if you look at, he showed this chart with the value chain for Mercedes, and pretty much every element of that is a partnership with a chemical company. And we're going to see the chemical industry play a very significant role in the energy transition. One segment, because of battery demand, is cathode active material. Dramatic growth rate over the next few years that we expect. A lot of this is going to be centered in Asia, obviously, but we see quite a bit of capacity coming up here in the US and to a certain extent Europe. The Inflation Reduction Act and some of the other policies that are being implemented, for example, the European counter proposal, if you will, to the Inflation Reduction Act that just came through last week, will drive a lot of capacity investments in some of these areas in these markets, because there are very strong local supply chain development incentives that are embedded in those policies. Solar demand, obviously, the photovoltaic demand has been growing at a fairly robust pace. We expect that to continue. What we are seeing, and a lot of our teams are doing a lot of work in trying to understand this at a more granular level, is what exactly does that do to polymer demand, because we're getting a lot of questions on those from our clients. There's about 10% of solar photovoltaic components are polymers, and as a result, we expect growth opportunities there. A lot of that market is dominated by EVA, but we are slowly seeing polyolefin elastomers make further room and headway into those markets. If you take a look at the green hydrogen value chain and you look at the value chain for electrolyzers, a lot of that is materials, right? There's obviously a lot of critical minerals and metals in there, but we also see a lot of polymers, engineered materials, elastomers, thermoplastics, that all are going to play a role as this value chain develops, creating opportunities in the medium to long term for these markets. And then finally, there's a pretty big shift in telecom infrastructure towards 5G. This creates a lot of interesting opportunities for a number of engineered polymers, whether it is the LCP substrates or the PTFE substrates. We see a lot of room and opportunity for growth here going forward.